So everyone wants to know these days, what is happening with multifamily lending, especially as interest rates are rising, right? I mean, if you hold assets, typically when rates are rising, do asset prices go down? What does it mean for what's happening right now in the lending environment? So today I have with me a special guest, my good friend, Julie Peterson from Old Capital Lending. She's also a syndicator. She's also just an amazing person, but she's here with me. Julie, welcome. How are you today?
Oh, thank you so much for having me. It's great to be here, and I'm doing great. It's
Good.
man, oh man, things are changing, right? Very
Yeah.
different than they were a year ago.
Yeah, they're changing. We just had, I want to just say something real quick about you have a program called Zoom at 8, which is Zoom at Tuesdays at 8 p.m. Eastern. And I just got to share about raising $12 million in 12 months. It was an amazing group of people. You had a really good crowd there. It was like 30, 40, 50. There was a lot of people there and it was awesome. It was a great event. So encourage everybody to check out Julie's Zoom at 8 event, which you'll see on social media. But talk to us a little bit, Julie. I want to get into your story because you've had a great story as well. I know we've had you at our meetup recently. But why don't you give us a little bit of your background, and then we're going to jump into some of the, a little bit about lending and what's happening, because there's a lot of changes right now that are happening. But give us kind of the 2-minute version of kind of what it is you've done and how you got where you're at.
Yeah. So I've been investing. I've been an investor and investing for 30 years. Bought my first house when I was 22 in LA. Have been up and down in the market. Owned and operated 20 up to 20 units, and I never wanted to partner with anyone. I always wanted to do it myself. I can do this myself. And in doing that, I really delayed a lot of being able to grow my business. And I have, been with lenders that said, go away, come back when you have all your partners. And I'm like, I am the partner. I'm the one that's doing this. So I said to myself, you know what? I want to get into lending. I want to help people. I want to be able to not tell them to go away. So a lot of my business that I do at Old Capital is about educating people, about giving them opportunities for seeing that you are capable of doing a syndication. You can use other people's money, but as a lender, I'm going to tell you, you need to have your own money. And I like to get people before they take their first step into this. And so we can break down all of the lending options. And no one did that for me. And so when I came to Old Capital about 8 years ago, I have 4 kids and they just were not ready. And so I kind of delayed getting into the mortgage business. I continued to own and operate my own. Also was passively investing in multifamily. And I came to Old Capital about 5 years ago and said, that's my mission. My mission is to help other people who haven't done this, who've done 1 or 2, because as a lender, we're a mortgage broker. We want to have a long-term relationship with you. It's not a one and done. A lot of people will send me an opportunity and say, oh, I've sent this off to all of my brokers. I'm like, you only really need one, because we're all pretty much going to the same place. Now I can open up my trench coat and I've got all the same lenders as another broker. But what's different about us, different about me, is that we have the relationships. And this is, while, relationships with your an insurance broker, with your attorney, with your investors, having a relationship with your lender, we're your number one partner. We're bringing everything to the deal. So having a great mortgage broker on your team and something that, you can hand over. You don't have to do this. Like if some of you are coming from single family, I know for me, I used to hand it off to a bunch of people and let them feed on it, right? Mortgage brokers in commercial are a little bit different. So just kind of, that's my background. And, the environment today is, as I mentioned, different than it was, 6 weeks ago, 8 weeks ago, 2 years ago. So I'm anxious to talk about that.
Yeah, no, I'm excited to talk. A lot of our audience, we have some active, a lot are passive and are just interested. The Mailbox Money Show is really dedicated to helping people generate passive income and look at different assets. And so, but I think it's really important for passive investors as well to look under the hood and really see how it all works, understand how lending works, what impacts lending, as rates rise, what are, the terms of certain loans, who could, as Warren Buffett says, if the tide goes out, we discover who's been swimming naked, which will happen, right? It's just the sense of people preparing and, really diligent sponsors preparing correctly. So let's just talk a little bit. I know, just a quick little summary. I think about 85% of debt these days is, bridge debt. So it's a bridge usually with a cap versus as opposed to agency or fixed debt, at least in the multifamily space. So can you talk a little bit about kind of what you see happening? Valuations coming down. There's some, we hate to use it's a bad word, but retrading, where people are negotiating discounts at the closing table. Investor appetite. I'd love to just kind of know what it looks like kind of at the, the loan desk, kind of what you're seeing right now.
Right. You're absolutely right. I mean, I would tell you the last 18 months to 24 months, we have seen 85 to 90% of our business in bridge. Okay. It's adjustable rate financing. And this has opened so many doors to so many people, whether you're passive or active. If you're a general partner, or it gave opportunities where you could take an asset and really redevelop it. You could really make something that was 1965 up to 2010, 2020, and we made a lot of rich people buy the debt that was out there. But with SOFR, which is, it's the index that is used. This is the short-term Fed funds that are being used on these types of loans. They're going up. Okay. At the beginning of the year, they were almost zero. At, January 2022, they were close to zero. And today they're at 1.52 on average. And so 30-day SOFR is on the move. I mean, we're talking about 3.31 by January of 2023. That's almost doubling. And so this is truly affecting how these deals are getting done. It's affecting the investors. Can you get the same returns? Probably not. From a seller standpoint, can I return my investment to my investors on the sales side? Not going to happen. So we're seeing, yes, agree, there is a lot of retrading going on. And in fact, I'm a general partner on a deal that we had. It was 40 million. We tried to retrade it down $5 million. And so it's happening everywhere. And I will tell you, it is going to need a shift from the seller, a shift from the broker, a shift from the buyer, from the investor, and obviously from the lender side. We're all shifting, and it's going slow.
Right. I want to touch base on one thing you said, because I think it's important for people to understand. A lot of people don't understand. So when we talk about bridge debt, and 85, 90% of debt these days is bridge debt, typically 2 to 3 years. And there's usually an extension or maybe a 2-year extension. You have certain extensions that can kind of built into it. But now, a lot of it's based on SOFR, right? So the overnight lending rate, and that is expected, it's gone up dramatically from 0 to 1.5 to maybe as high as, over 3% by the end of this year or by January. But when we talk about the interest rate caps, right? You talk about that there's, a cap that you do. It's like an insurance that goes on it to where, so we have a deal recently that, it's 4.5% currently. We expect, I think it can't go higher than 6.25 to 6.5 or somewhere in that range. Can you talk about how those caps operate? And is there any risk that you see in even having interest rate caps? Is there any counterparty risk that if those the insurance companies fail, or kind of how that all works?
Yeah, I mean, gosh, that's always a possibility. Have we seen that? No. These interest rate, we call them rate caps. Okay. And there are a couple different companies that run them. Basically, I'm in agreement. This is a insurance policy for the people that own the deal. It's also to make sure that the lender is getting paid. So if you think about, as using that example of what you're saying, at 3, it's 4.25. You would buy maybe an interest rate strike price of 2%. So that would go from again, 425, 450, you'd have to cover the mortgage 550 and then 650. And then at 661, that company would pay the difference, right? So they would never be not able to cover it. The problem is that these rate caps are based on the bond market, which is going up. As stocks come down, bonds go up. So we've seen it starting at 2%, and that's a 2% cost of the deal. And now we're seeing 2.5% to 3. And that is a 2% strike for 2 years. Now, as you mentioned, these loans are 3 years typically. Okay. So if you buy a 2-year cap, you're going to have to put some money in escrow to get that 3rd year rate cap. Well, maybe it's going to be $1 million on that 3rd year. We just don't know. So there's a lot of risk involved in these rate caps. And if you're doing a deal where you can't afford to increase that mortgage, let's say 2%, you can only do a 0.5%. Well, that rate cap that costs $300,000 now may be $900,000. So you have to figure out what is the stress test on these deals, and a lot of them are falling out, or they need to be retraded. I will tell you where we're going to see some failure coming in, because 2 years ago we didn't even have to have a rate cap on these deals. So let's say guy got into the deal for 3.5, didn't have a rate cap, and now is finding themselves at 5.5.
Right.
That payment just went from $6,000 a month to $20,000 a month. All right. This is where we're going to see cash flow problems coming. And if you're in your 3rd year, say you took it out 2 years, you're looking at this 3rd year to refinance or sell. On these refinances, which you're probably looking to get into an agency loan, we are not seeing 75 to 80% leverage on agency. We're seeing them at 50 and 60, maybe 65.
Why is that? Like, why is that happening? Why is the leverage higher for agency right now?
Well, because it is based on NOI. Agency is a cash flow lender. We look in the rears. We look over the past 12 months. Okay. And because the pricing has been so high, the NOI it's constrained. The debt service coverage is constrained. Therefore, we're only able to give you 50 to 65 to cover that debt service.
I want to bring up something that I think is really important, and I think it's something that you touched on, is really, what's going to happen 2-3 years down the road with some of these folks that, or maybe even people that have loans that are starting to come due. And it's something that is interesting. I'd love to know your thoughts on this, but I see people that do Class A type of apartments. And to me, it's always felt like the highest risk place to be, because you're buying a brand new asset. If there's a recession, rents come down in Class A typically the quickest. Secondly, you don't have a margin of safety of having upside and say, hey, we're going to go renovate and we're going to see this rent upside. For example, in Jacksonville, we're buying stuff. It's about $922 a month in rent. The going rate is $1,460 currently. Obviously, it could come down, but there's a lot of upside. So as long as we can work that plan in the next 2 to 3 years, there's some kind of built-in margin of safety. But are you seeing it kind of similar? Just that there's a fair amount of risk if people don't have a good value add component, or if they're just assuming they're going to be able to refinance in 2-3 years.
Listen, all of real estate, it has its own set of risk, right? I mean, I do like A assets. I mean, I think that they're great. Yes, they're the first one to come down, but your expenses are the percentage is so much less that the risk, you're probably getting a much lower return per se, but it's not as risky in my mind. The B's are really where it's at, because you can take a B location with C, and then when we're doing this, I'm a general partner on a deal where we've got C tenants, and we're renovating every unit. We're getting rid of C tenants and we're bringing in, we're renovating it to an A minus B plus, and we're bringing in A minus B plus tenants, residents. And that is the greatest upside, but it's a lot less than you would on a C. If you got C tenants, you got C asset, you're probably going to want to get in and get out as quick as possible. That's your biggest risk.
Right. Sure.
But I would tell you that, the upside on doing a heavy renovation, you have to look at what's going on in the market. You can't just say, I want to do a light value add and think it's going to work. There has to be rent growth, there has to be population growth, there has to be the metrics, the foundations for that market.
Yeah, no, absolutely.
And they're not always there, right?
No, they're not. And I think we can be excited about a story that's not necessarily the story that's happening or continuing. Let's fast forward here a minute. I want to know your opinion, Julie, because you're seeing this. Obviously, no one has a crystal ball, but when we look in the past, we look at the Fed tightening rates. We're still historically low, very low compared to where we've been over historic years. But typically, the Fed will tighten rates on an average of around 2 years. And the longest, is my understanding, is the longest they've ever tightened is about 3 years. And then they start loosening again. But because of the trend, I did a video, my friend Brian London, who runs the New Orleans Investment Conference, was talking about this, about how if you look over the last 15 years, just the kind of rate has just continued to go down and down and down. And that at some point, if they're raising rates, even toward the end of this year, if they keep aggressively raising them, could there be some lending, some industry that can't handle such a quick raise in rates? Maybe not necessarily multifamily, but maybe some other industry to where now this is essential and all of a sudden they have to bring rates down again. Do you think that's a possibility, or do you think we're only going to go up from here and it's just going to be, years of higher rates?
I think that, again, we are historically still low. I mean, we're still in 2018, 2017. I think that's where, today I was spending some time looking at the 10-year treasury, looking at the SOFR, and quite frankly, it goes up and goes down over a 3-year period. I think, we're in that trend where it's going up, and it's going to take us 18 months, 2 years to see it drop. Is it going to drop to where it was before? I don't think so. I think we're going to be up 7 and we're going to drop back down to, let's say, 4.5. I don't think we're going to go back down to the 2s and 3s, but there are different asset classes that are still struggling. And you talk to different economists. I think everybody has a different view of this. Office is still, are people going back into the office? For people in my generation, we go to the office. So those economists that are in our age group are saying, yeah, we're going back. That's how it's going to be. The new generation is not on board with that idea, right? So I don't think you can see the trend saying that we're absolutely going to be back there. I think industrial is also a very good place to be. I think, the supply and demand has affected them a little bit, but I do think that there's great opportunity in industrial. We are specialists in multifamily. We will look at other asset classes, but for the most part, I think, they're pretty consistent. Right.
You have a very unique view, Julie, because you are a syndicator and you do have an educational program as well. And you've been a lender for years, and you've done single family, done a lot of other things.
Yeah.
So it sounds like you like industrial. Let me just go back to, let's just say the Fed does keep raising rates for the next 2 years. And in 2 years, we're at 5-6%, whatever. What does that do? I mean, do you think that creates like a high amount of distress in the multifamily or other real estate space? Or do you think people will be able to just kind of generally be able to weather it? Or do you think, is it possible that, rates go up, but valuations also go up because we're so short on affordable housing, somewhere between 2 and 7 million units nationally? Do you think that there's a chance that, maybe rates go up, but valuations don't necessarily go down as much as people think they might go down?
No, I do think there has to be a correction on these prices, honestly. I think you're going to see cap rates going up we're not going to go into negative arbitrage. We can't continue to see that be a trend. I think, overall, we're going to continue to see the reversion cap rates. You're going to at one point we saw 25, I think, pretty consistent 10 bips per year on a reversion cap rate. I think that, listen, single family, we don't have the units coming on board. I think we're probably 4 years. If we keep the units coming on board over the next 4 years, we're going to get caught up on multifamily. But listen, a lot of these people want and need to get into single family, but we're just not keeping up with single family, which to me begs the reason why we stay in multifamily is because people cannot afford to get into single family. I think over time they're going to have to either double up in households so that you can save money, so that you can get into a little bit higher valued single family. But I am very bullish on multifamily, and I think that that's here to stay for quite some time. It's not, I don't think it's just what like we saw since COVID, this crazy rush. I don't think we're in that. I think it's going to be a steady, once interest rates go up and then come down. I think it's going to be a steady, slow growth. Over the last 10 years, interest rates have been 4.75 on average, right? They've been lower, they've been higher, but 4.75, 5.25 is pretty consistent. This is the long game. It's not quick, easy. And that's, I think, where a lot of these people got into, investors, whether they were buying or they were investing. We saw your money turn quickly. That's not gonna, I don't think we're gonna see that again
happen
in the near future.
Yeah, so I guess it's interesting with all of this. There's history. It's, again, I look at all this and it's like a game where the rules keep changing, right? There's just things that keep happening. There's new information, and we had a period between February of 2020 and February of 2022, so a 24-month period. There was a 40.9% increase in the U.S. money supply, either physically or digitally, and that has really never happened before. So, do you think that with them just way more money in the system, does it go to asset prices? Does it go to rents? Does it go to other things, particularly when there's shortages? I mean, does that make it to be different, or do we still just kind of go back to historic? Because I hear you saying it's more, well, this is kind of historic. It's going to go this way. It's going to kind of go down, and we're going to kind of make it work. And obviously, we're short single family, but do you think that has a special impact kind of during this season that maybe we haven't seen before?
All the economy, it is higher level than me. So I would say that, there's, what, $6 trillion out there in cash. And I have to think that they're going to be dumping some of that into our, obviously the supply and demand that we're seeing right now is affecting many people. We've got people, more employment. We've brought on 2.7 million new jobs. So listen, we've got a strong economy. It just keeps going. How long can we continue to pay these high prices? I think the inflationary environment needs to get under control. And I think once we have that, who knows what's going to happen, right? I mean, I don't think we're playing the same chess game. I think we've got a completely different playbook. And how is that going to play out? I still think that multifamily is a strong asset class. I do. And the rents just keep going up. Do I think we should be underwriting at 12% year 1 and 2? Absolutely not. But I think that there's still a lot of the metrics that are supporting continuing to look at. I mean, looking locally here at some of the apartment complexes, every day they're shifting. Every day they're going up. Sign that contract now, because in 24 hours it's going up. How long can that go on, though? How long can that go on? How long can Americans continue to pay that? there's got to be a stop to this.
Yeah, no, I agree. I think it is interesting. It's changing. It's almost like we're in the dark a little bit on some of these things. We don't know exactly what's happening. Well, appreciate that, Julie. I mean, you really have a lot of insight because of your experience, what you're doing at all different levels. I want to shift gears for a minute before we kind of wrap up. I know we're just kind of touching on the surface of some of these things. That's why people need to check out your Zoom at 8 and spend more time with you. I know you have a lot of stuff out there online as well. But let's take. I know you work with a lot of people. You see a lot of people getting started. What advice would you give to somebody starting out? What advice, particularly somebody who, maybe they're new to real estate or they're interested in being passive? Like, what are some things that you would pay attention to right now?
Well, there's two things that I always say for people that are just hearing about multifamily and getting excited about it, because listen, I am passionate and most people in multifamily are excited. I mean, we are excited to see how our assets grow. I mean, it's never been, these are recession proof assets that we're involved in. Two things I say. One, get educated. Listen to as many podcasts as you can. Come to Zoom at 8. Get to understand, be part of something greater than yourself, to be inspired. And it's only when you get educated that you can make educated decisions, right? So one is that, and when you get to know people and networking, you get to be involved and be exposed to opportunities. And the second piece would be of that is to be exposed to being a passive investor. How will we ever know what our capabilities are as a general partner unless we are investing in these deals? You want to invest in deals with people who have a track record. Okay. And that's why I say, get exposed when you're educating yourself. Get exposed to as many people, build those relationships, because it's all about the trust. Now, listen, when you're partnering with people, trust and partnerships are so, so important. And you never know who you're going to partner with until you get into a deal and money is on the line. And you can't do that fast. I have vetted my partners for 4 years. So it's not get rich quick. This is the long game. Take your time, get to know people, visit with them, call them, and invest in their deal if you believe in them. And they have a very solid background.
Yeah, no, it's really a good word. It's just making sure you know who your partners are. I think I have the opinion that you really don't know your partners until you've done a deal together. And that's what's challenging. You don't, even if you've known them for years, it's hard to know how they'll respond if, things don't go their way or you have a conflict or anything like that, particularly if you're managing a deal with them. But even as an investor, it's you really don't know. And that's why now, I'm sure you're having this as well, where once people have invested, then they tend to refer if they've had a good experience and that kind of thing. And so we're getting more of those referrals. But Julie, I just wanted to say, I really appreciate your friendship. You're always, encouraging. You always have a positive word to say about everybody. You're obviously adding a lot of value to community in the different areas you're involved in. Your Zoom at 8, you work in different spaces teaching, and just really appreciate that for you. And I know you spoke at our meetup recently, which was awesome. But I just encourage everybody to reach out to Julie and hear about her deals. Also, she is a lender, so she can help out on the lending side as well. But Julie, what's a good way for people to get in touch with you?
Great. Well, thank you for acknowledging our relationship. I love working with you, Bronson. You're solid, and I look forward to continuing to build on that. But I am on all social media platforms, so you're welcome to find me there. I'm on our website at oldcapitallending.com. My phone number is 630-453-7150. Would love to have a 20-minute chat, see how I can help you.
Awesome. Well, Julie, thanks so much. Appreciate you coming on today.
You're welcome. Thanks so much.
So Julie Peterson, obviously lots of varied experience, years of being a lender, a syndicator, single family, multifamily, other investments. She's got some really awesome thoughts on just, what to do. And some of these deals that we're currently seeing are not as attractive as they used to be. With that said, I still like deals that have a lot of upside, right? You're seeing in the market, you're seeing that value add component. So I'm a big value add type of person to be able to see that. But I think in general, it's really important to pay attention. It's important to pay attention to lending. It's important to pay attention to the specific deal and the operator and see what people's plans actually are, right? Because people can be just all intentional. Here's what it's only going to go up and to the right. And, as Mike Tyson says, everybody's got a plan until they get punched in the mouth. So my hope is that you don't get punched in the mouth, but if you do, you have a plan. You have something that you've prepared for that, even if things don't go perfectly, you will plan things to go well for you. And I'm really passionate about this as well, because I think that right now, a lot of people are just really on hold. They're really not doing anything. And I think there's some benefit to that. I personally believe with all of this new money that's in the system now, that inflation and perpetual high inflation is inevitable. But just by sitting on cash over the next 24 months, you could lose 35 to 40% of your wealth. And the reason for that is just due to inflation. Inflation is actually more like around 15 to 17% or higher. And so there's a lot of loss of wealth that's going to happen just by sitting on your wealth. So finding ways to hedge inflation is really important. So on that note, if you haven't checked out my new ebook, it's called How to Use Inflation to Your Advantage. I have it right here. This is basically the cover of it, and it's a free download on my website, bronsonequity.com. And you can just go to bronsonequity.com and go to the page there, and it will you can do a free download. But it gives you ways you actually can take advantage of inflation, make it your friend, and it will actually benefit you rather than hurt you. So thanks for taking the time to educate yourself. I say thank you because it is important to educate yourself, but it's something that we do together. So thanks for being a part of this community, and I hope you got a lot out of this. We'll look forward to seeing you on the next episode of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.